10-year note treasury yields are coming off their lowest mark since October of 2017. And we got down to 229, just 4 basis points above the bottom level of the Fed's target range, which is 225 to 250. So right now there is sort of an inversion going on between funds and 10-year notes, which is very rare and obviously means that there's something awry or something not right in the markets. And one of the things we've been talking about for quite some time is the decline in treasury yields as equities have outperformed or continue to outperform from their stock losses and rallies. We've seen the treasury market be very much a one-way directional trade with yields going lower. So what does the bond market know that we don't know? Well, I think at this point right now it becomes more of a flight to quality bid. There is some risk. There's likely some scarcity involved there. And I think ultimately when you look at the news, the China news, the Iran news, what's happening in the UK, Washington, D.C. politics at its best, all that is creating sort of this uncertainty, and I think that that's why the bond market is finding much more favor than maybe would have guessed. Market volatility did start to bid as we broke out of the range yesterday, and it held its bid today as we head into a long holiday weekend. And I think that that's a sign also that the market is starting to get a little uneasy. We saw bond market bid towards its highs. It did not exceed those highs. On these breakout moves we've seen in the 10-year, volatility has been going up but not exceeding previous highs. So right now the market may be a little tired as we trade on these low yields, but I don't think that it's done being pushed around just yet. I think there is some more room to the downside. There is some more buying that is necessary out there, and that will continue as long as a lot of this uncertainty continues to hover over the market. And lastly, the one biggest player in this, the Fed. What is their role here? Well, the Fed has been telling us that they want to be patient with their policy. They're looking at some of the inflationary mishaps as transitory, but maybe it has a bigger meaning. Maybe their patience is more about the bond market. They're not going to influence the bond market and try and push yields higher. Obviously, they don't want to raise rates or lower rates at this point. They want to keep them steady, but what you're seeing in the 10-year market is something completely different. And if the Fed is going to do that, then they're going to have to back off some of their balance sheet adjustments, and that may be the reason why we're seeing yields come off so quickly and so with such momentum. So at this point, I think the Fed is watching with its hands off the market, letting things kind of happen as they may, and that may be one of the bigger reasons why the bond yields have tumbled over the last several months. And I think ultimately at this point, the flight to quality bid is not over, and if it does break below the target range, which is 2.25 to 2.5 in the Fed effective range, if we get yields below that, then look out. That could create even a bigger trade to the downside yield speak for higher prices. So right now the bond market very, very bullish, despite the fact that we did not see a push even lower today following yesterday's big move in the bond market.